Silver just flipped into a different species of market, and the people who set the price are trying to pass it off as noise. Not because nothing's happening, but because if you understand what's actually happening, you stop trading headlines and you start watching the plumbing. And once you see the plumbing, you realize why the words sovereign rotation aren't hype, they're a warning label. Because if this one level holds, the math changes. And I'll give you the exact checklist for the next 1 to 2 weeks. What to watch, what confirms it, what breaks it, and how a move people laugh at today can become the move everyone pretends they always believed later. But first, you need the uncomfortable reframe. Silver is small, not spiritually small, structurally small. The pool of readily mobilizable, benchmark-grade silver that actually matters for price discovery is not infinite. It's not even close. And that's why the silver bigger than Apple line hits people like an insult, until they do the arithmetic. Apple is measured in trillions. Silver's critical liquidity pool is measured in tens of billions. That difference is not trivia. That difference is leverage. Because when the pool is small, you don't need the whole world to agree. You need one serious buyer to decide that insurance is not optional anymore. And that's where the real pressure starts. Here's what's happening right now, in plain terms. Silver has been living in a regime where it can go vertical, then it can snap back, then it can rip again, because the market is being yanked by flows that are mechanical, not emotional. You're watching price whip around the 80 area like it's a magnet and a minefield at the same time. That's not because the market is confused. That's because a lot of positions were built when silver was cheaper, liquidity was deeper, and people thought they had time. Now they're finding out they don't. And the funniest part is the mainstream explanation will always be something like profit taking or risk off. It's always vague. It's always safe. It's never the mechanism. But the mechanism is the story, and it shows up with a date stamp. This week, there's a force pushing back that has nothing to do with what anyone believes about silver. It's rules-based, it's calendar-based, and it's powerful enough to make a real move look like it's stalling. Commodity index rebalancing windows, like the one that tends to hit in early to mid-January, create systematic selling and buying across commodity futures, whether you like the narrative or not. It's not a conspiracy, it's a schedule. It's a portfolio rule. It is the kind of flow that can push price down on days where the underlying physical reality is getting tighter, not looser. And if you don't know that, you misread the tape. You start thinking the thesis died when it's just being stress tested. But that's not the part that matters. The part that matters is the hidden detail, because it reframes everything you think you know about supply and inventory. The hidden detail is brutal. The world can have enough silver in total and still have a crisis, because the silver is in the wrong place. That's the entire game right now. Silver is not just a number on a screen. It's bars, it's vaults, it's locations, it's deliverability, it's logistics. And the benchmark pricing ecosystem is anchored in a specific place with a specific network, London vaulting, OTC liquidity, and futures-linked price discovery. When metal migrates out of that network into places where it's effectively sticky, you can have a world that looks well supplied on paper and feels tight in the channels that actually clear the market. And when that happens, price doesn't rise smoothly. Price snaps, price gaps, price hunt stops, price punishes certainty. Because the market is trying to rediscover what available even means. And if this one location mismatch persists, the upside becomes discontinuous. Now let's strip out the drama and do the structure. A huge amount of trading in silver happens in paper form. Futures, forwards, swaps, unallocated accounts, hedges that net out. Most participants are not taking delivery. They're managing exposure. They're rolling contracts. They're arbitraging spreads. They're hedging inventory. That's normal. That's how modern markets function. But it also creates a situation where the printed price can be heavily influenced by paper flows, even when the marginal physical bar, the one that matters for an industrial buyer who needs real metal, has a very different scarcity signal. And when those signals diverge, something has to give. Either the physical market loosens or the paper market reprices to reflect the new stress. And that's where the real conflict shows up, because different players have different incentives. Producers hedge because they want stable revenue. Manufacturers secure supply because a missing input can halt production. Dealers manage inventory because financing costs and spreads can kill you. Funds chase momentum because that's their mandate. And sovereign scale capital, this is the key, doesn't care about your daily candle. It cares about regime risk. It cares about reserves. It cares about political constraints. It cares about the kind of world where the old assumptions stop working. And that SY, sovereign wealth rotation, is even being whispered in a silver context at all, because the psychological shift from silver is a trade to silver is strategic is what detonates small markets. But that's not the part that matters either. The next detail is what flips the whole setup, the benchmark ecosystem. S-effective liquidity is not the same as total above-ground silver. People love to point at total above ground stock like it's a get out of squeeze free card. That's like saying there are plenty of cars in the world, so your city can't have a rental car shortage during a holiday weekend. The cars exist. They're just not where you need them, when you need them, at the price you need them, with the paperwork you need. And commodities, location, form, and deliverability are everything. Some inventory is deliverable, some is not. Some is pledged, some is leased, some is in products, not bars, some is in private hands with no incentive to sell, and some is sitting in vault categories that look like abundance until you realize what portion is actually mobilizable without blowing out spreads and financing. So when you hear there's plenty of silver, your next question should be plenty of which silver, in which form, in which location, under which financing conditions, available to whom, at what premium, on what timeline? Because if you don't ask that, you're arguing about ghosts. And that's where people get hurt. Now let's stack proof, because we're not doing this on vibes. Proof point 1 is simple and boring, which is why it matters. Structural deficit talk has been persistent. Multiple industry-focused analyses have described recent years where demand, especially industrial demand, has run above newly available supply plus recycling in ways that draw down available stocks over time. You don't need to worship any single number. The direction is the signal. When an input gets tighter year after year, the system becomes less tolerant of shocks. It becomes less tolerant of sudden procurement. It becomes less tolerant of logistical disruptions. That's how you get a market that can look calm, then explode. Proof point 2 is the industrial pull that doesn't care about your macro take. Silver is not a pure monetary metal. It's a hybrid. It shows up in electronics, solar, industrial processes, and a bunch of places where substitution is hard and quality standards matter. When industrial users need silver, they don't wait for a dip the way a retail trader does. They manage continuity, they sign contracts, they secure inventory. And in a regime where supply chains are being politicized and delivery reliability is being re-rated, continuity becomes a premium in itself. And that's not a story about this year or last year. That's a story about right now, this month. As procurement departments start treating metals like strategic inputs instead of commodities, you can always source tomorrow. But here's the part that matters. Industrial demand doesn't need to surge dramatically to break a small market. It just needs to be steady while liquidity fragments. And that's where the real pressure starts. Proof point 3 is fragmentation risk. In a world where tariffs, export rules, sanctions, and friendshoring start to creep into commodity flows, arbitrage gets slower and more expensive. In a frictionless world, if a price dislocation appears between region A and region B, traders move metal or paper claims, and the gap closes. In a frictioned world, those gaps persist longer. The market becomes a set of semi-connected pools. And semi-connected pools are where squeezes are born because the usual pressure relief valves don't open fast enough. That's not a theory. It's the lived reality of multiple commodities in recent years, from energy to industrial metals. Silver is not immune, especially when you add the location mismatch dynamic we just described. Proof point 4 is sensitivity. There has been recent commentary framing that silver ES price reaction to incremental demand has increased substantially under tight conditions. Again, you don't need to memorize a percentage to understand the mechanism. When the available liquidity pool is small, a marginal buyer matters more. When the system is already running tight, it takes less additional demand to move the price. That's the definition of convexity in a physical market. And that convexity is why people throw around targets that sound insane. Not because someone has a crystal ball, but because convex markets don't move linearly. They move in steps. Proof point 5 is investor flow capacity not being maxed out in some plumbing indicators. This is subtle, and it's important. In prior cycles, silver saw major inflows through vehicles that claimed physical backing, and those holdings reached extremes. In the current cycle, price has already surged, but some indicators of broad investor positioning and all-in behavior don't necessarily look as extreme as you'd expect if we were already at the end of the story. That doesn't guarantee anything. It just means the market might not have exhausted its ability to attract incremental capital if the narrative flips from trade to regime hedge. And if that flip happens, the next phase won't announce itself politely. It will gap, it will force, it will punish hesitation. Now, let ES talk about the sovereign wealth rotation idea without turning it into a cartoon. Sovereign money doesn't need to file a press release saying we're buying silver. Often it can't. Often it doesn't want to. The footprint shows up indirectly. Shifts in reserve management, changes in what's considered politically safe to hold, increased interest in real assets, and a general move away from concentrated exposure to a single currency regime. We've already seen how sovereign and central bank behavior can matter for metals. Gold is the obvious example. Silver isn't gold, but the philosophical driver can rhyme resilience, diversification, optionality in a world that feels less stable. And when capital that big looks at markets, it doesn't ask, is this expensive? It asks, Can I get size without moving it too much? That's the killer, because in silver, the honest answer is often, not really. Size moves the market. Even a small shift in institutional allocation, tiny relative to sovereign portfolios, can be huge relative to the effective liquidity pool. That's why the Apple comparison is so powerful. When a single megacap is worth multiple trillions, and the benchmark pool of silver liquidity is in the tens of billions, you don't need a tidal wave. You need a cup of water poured into a shot glass. And that's where the real pressure starts. Now, if you're thinking, okay, then why doesn't price just go straight up? Because the market isn't a textbook. It's a battlefield of hedges, financing, and forced behavior. Producers and merchants hedge into strength. They have to. That's risk management, not bearishness. Funds take profit into spikes, because volatility forces them to. That's not disbelief, that's survival. And then you have the calendar flows that hit, regardless of fundamentals. Early January index rebalancing is the kind of thing that can create air pockets. Add thin liquidity around weekends. Add risk management ahead of key macro prints. Add the fact that silver is famous for violent stop runs. And you get this, a market where the thesis can be right and the price action can still try to destroy you. That's why you need the psychology shield. Because Silver ES' favorite trick is to convince you that you re-late when you can re-early, and convince you that it's over when it's just beginning. Here's how the manipulation works. Not a shadowy villain, just volatility itself. Silver spikes, and your brain starts anchoring to the high. Then it pulls back hard, and your brain interprets the pain as information. If it hurts, it must be wrong. Then the media finds a reason after the fact. Dollar's stronger, rates higher, risk off, whatever fits. You sell because you want relief. Then silver stabilizes, builds a base, and rips again. Often when you least expect it. Often when you've just sworn you're done. The cycle repeats. The way you break that is not by being brave, it's by being structured. You separate trend signal from noise. Trend signal is what happens around key levels with follow-through and absorption. Noise is what happens in the middle of nowhere on low liquidity with headline-driven whips. And this is critical. You accept that even if your thesis is correct, price can whip around violently. That's not a bug. That's the cost of admission in a small, leveraged, reflexive market. Now let's make this practical, because sovereign rotation is not actionable unless you can see what it would force participants to do. In the paper market, the key is what happens when price holds above psychological and structural levels. When silver is flirting with the $80 handle, it's not just a number, it's a line where positioning shifts. It's a line where risk managers change limits. It's a line where short sellers who were comfortable at $30, $40, $50 start facing a different margin conversation. If that level holds, and then the market grinds higher, the pain becomes persistent. Persistent pain changes behavior. Shorts don't need to be wrong fundamentally to be forced out. They just need their financing to get tight and their drawdown to become unacceptable. That's short covering mechanics. It's not dramatic. It's paperwork and margin calls. It's an email from a prime broker. It's a risk committee meeting. It's a fund deciding to cut exposure because volatility is killing their VAR. And when short covering starts, it's not a gentle buy order. It's forced buying into strength, which is how squeezes sustain themselves. But that's not the only engine. The other engine is physical stress showing up as spread behavior and premiums. When physical metal gets tight in a specific location, the market often communicates through the basis, through lease rates, through EFP-type signals, through the cost of turning a paper position into metal. You don't need to be an expert to understand the translation. When it becomes more expensive or more difficult to source the real thing relative to the paper claim, the market is telling you that the printed price is not the full story. And when enough participants see that, behavior changes. Dealers widen spreads, fabricators bid up for reliable supply, arbitrageurs demand more compensation to move metal. All of that is inflation in the physical channel, even if the screen price looks contained for a moment. And that's where the real pressure starts. Now we need to address the $350 target, because it's in the title and it's a psychological grenade. If you treat $350 as a prophecy, you'll get wrecked. If you treat it as a scenario outcome of a convex market under stress, you can learn something useful. $350 only becomes plausible under a specific set of conditions. Sustained location, mismatch, persistent deficit-like tightness in mobilizable inventories, a significant incremental wave of investment demand, and a structure where forced buying feeds on itself while physical supply cannot respond quickly. Silver supply doesn't scale overnight. A lot of silver is byproduct production from other metals. Mining projects take years. Refining and logistics have constraints. Recycling responds, but with lag and price elasticity limits. So if demand pressure hits suddenly, especially demand that insists on physical availability rather than paper exposure, the market can overshoot violently because the short-term supply curve is steep That's the real mechanism behind crazy targets. Not mysticism, not certainty, just convexity. But here S the credibility anchor. You don't need 350 to have a generational move. You need to identify whether the market is transitioning into a regime where pullbacks are bought aggressively and spikes don't fully mean revert. That's the game. Now let's be honest about counterpoints, because skeptics aren't wrong to be cautious. Silver has burned people for decades. It's volatile. It's prone to head fakes. And there are clean ways this setup cools off. One is simple. The calendar flow fades. If index rebalancing and systematic selling pressure has been leaning on price, once that window passes, the tape can change character. But that can work both ways. Remove the mechanical selling, and you might see what demand was hiding underneath. Another counterpoint is that policy uncertainty can ease. If some of the fragmentation fear cools, arbitrage can function better, reducing dislocations. Another is that metal can flow back into benchmark liquidity channels if the incentives change, if premiums compress, or if financing conditions make it attractive. And a final counterpoint is macro shock. If you get a sudden liquidity event where everything is sold to raise cash, silver can get hit even if the longer-term thesis remains intact. That's not a contradiction. That's how markets behave under stress, which brings us to the two scenario lens you need right now, this week, this month. Scenario one is the controlled pullback and retest. In this scenario, silver fails to run straight up, pulls back towards support, and then finds aggressive buying. You'll see it in the way dips get absorbed quickly. You'll see it in the inability of price to stay below key levels for long. You'll see higher lows forming. You'll see volatility compress a bit before the next push. This is the healthier scenario for trend sustainability, even if it feels boring. Scenario two is the continuation squeeze. In this scenario, silver doesn't give everyone a neat pullback. It holds the $80 region, reclaims the recent highs, and then starts gapping in a way that feels disrespectful. You'll see thin liquidity. You'll see daily ranges expand. You'll see price ignore overbought signals because forced buying doesn't care. This is the scenario where people get emotional fast, both bulls and bears, because gaps create regret and panic. And this scenario carries gap risk in both directions. If you're over-leveraged, it can end you even if you're right. Because if this one level breaks, the math changes for you, not for the thesis. So here's the roadmap for the next 1 to 2 weeks, and I'm going to keep it concrete. First, treat the $80 handle as a pivot zone, not a magic number. If silver can hold above it on a closing basis and recover quickly from dips below it, that's confirmation that buying pressure is real. If silver loses it and starts spending time below it with accelerating downside and failed rebounds, that time is a warning that the market is still digesting flows, and you need to respect the downside volatility. Next, watch the mid-Salvio 70s region as a practical support band in this regime. If price is living in the 70s to 80s, and the thesis is intact, dips into that area should start attracting serious buying. If those dips get bought but the rallies keep failing immediately, that suggests supply hedging and mechanical selling are still heavy. If those dips stop getting bought and price slides with momentum, that's a sign the market is unwinding positioning, not just shaking out weak hands. An invalidation level isn't a single tick, it's behavior. The thesis weakens when the market starts making lower highs and lower lows and cannot reclaim broken levels after multiple attempts, especially if that happens after the calendar-based selling window should be fading. And the thesis strengthens when the market can absorb selling without collapsing, and when sell-offs are sharp but short and rebounds have follow-through. But that's not the part that matters. The part that matters is what you watch beyond price. Watch anything that hints at physical stress, premiums that stay elevated, spreads that widen, signs that deliverable availability is tight in the benchmark ecosystem, chatter about sourcing difficulty, and any persistent dislocation between paper pricing and real-world procurement behavior. Watch for the market structure tells. Is volatility rising with price, or is it rising on sell-offs? Rising volatility with rising price can signal stress and forced behavior. Watch the calendar. Early to mid-January, mechanical flows can create false negatives. If price holds up through that, it's information. If price snaps higher right after that, it's also information. And if we get a weekend gap, pay attention. Thin liquidity makes metals jumpy, and the first move after a gap is often designed to trigger emotional decisions. This is where the psychology shield becomes non-negotiable. You're going to be emotionally manipulated by volatility, whether you're bullish or bearish. The market will spike and make you feel stupid for not buying. Then it will dump and make you feel stupid for believing. Your job is to stop treating those feelings as signals. Your job is to operate with rules. One rule: if you're going to participate in a market like this, you size so that a violent move does not force you to do something dumb. Another rule: you distinguish between a thesis and a trade. A thesis is about structure, tightness, fragmentation, flows, convexity. A trade is a timed expression with an entry and a risk point. Confusing those is how people blow up. And the simplest rule of all is this: Don a T, let a single day S candle decide your worldview. Silver is famous for stealing conviction with noise. If you want to be on the right side of regime change, you have to accept noise and focus on the signal. Now, let's circle back to the sovereign rotation concept and make it real. If sovereign scale money is rotating into real assets more broadly, whether through gold, strategic commodities, or reserve diversification, the first effect is not a headline. The first effect is pressure on small markets. Because large markets can absorb flows. Small markets reprice. Silver is the definition of a small market that people treat like it's huge because it trades a lot of paper volume. But paper volume is not the same as physical depth. And when the world starts caring about physical depth, about what you can actually own, move, and rely on, paper depth becomes less comforting. That's the shift. It's a shift from price as a signal to availability as a signal. And when that shift accelerates, the market can go from orderly to disorderly quickly. That doesn't mean it's guaranteed. It means it's possible. And in finance, possibility plus convexity is enough to matter. But that's not the part that matters either. The part that matters is whether you can recognize the moment the market can unsee the line. If silver keeps respecting higher supports, if it keeps snapping back after sell-offs, if the $80 region starts acting like a floor instead of a ceiling, then the market is telling you something. It's telling you that sellers are no longer in control, even if they can still create pain. And if that happens, while the calendar-based mechanical selling is fading, that's a powerful combination. Because then, what looked like a stall becomes a launch pad. And that's when the conversation changes from, is this a bubble, to why didn't I take it seriously? And if the market pushes into new highs and holds them, the next phase will not be polite. It will be loud. It will be messy. It will be the phase where people start throwing numbers like $350 around because the market is behaving in a way that makes linear thinking look ridiculous. In that phase, you don't win by predicting an exact top. You win by not being shaken out by the games silver plays on the way up. But to keep this grounded, let me say it cleanly. Silver can absolutely pull back hard, even in a bullish regime. It can drop fast. It can trigger panic. It can make every comment section turn bearish in a day. That can happen while the structural story remains intact. That's why your risk framework matters more than your opinion. And it's also why you should ignore anyone promising guaranteed outcomes. Markets don't owe you anything. They punish certainty, especially in silver. So here's the final checklist, the one metric everyone should watch without getting lost in noise. 1, does silver hold and reclaim key levels quickly after dips, especially around the $80 pivot? 2, do pullbacks find buyers in the mid-70s region? And do rebounds have follow-through? 3, does behavior improve as mechanical calendar flows fade, suggesting underlying demand was being masked? 4, do signs of physical tightness persist? Premiums, spreads, procurement chatter, anything suggesting location mismatch remains? 5, do we see a shift in tone from trade to strategic in the broader real asset conversation? Because that's how sovereign and institutional money moves before it's obvious. If those are lining up, the bullish regime is intact, even if it's violent. If those are breaking down, failed level reclaim, persistent lower lows, fading rebound strength, loosening physical signals, then you respect the possibility that the market needs a deeper reset before it can run again. And notice what I'm doing. I'm not telling you what to believe. I'm telling you what to watch, because the people who win in markets like this aren't the loudest believers. They're the ones who can stay rational when the screen is trying to hypnotize them. And if you're still here, that's probably you. You're not looking for cheerleading. You're building a lens. You're building the ability to see structure when everyone else is arguing about sentiment. So keep your identity tight. You're not the crowd chasing candles, and you're not the cynic who misses regime change because it sounds dramatic. You're the one watching the plumbing, watching the calendar, watching the levels, and refusing to be emotionally rented by volatility. Because in a small market with big capital sniffing around, the whole game is staying alive long enough to be right. And if the hidden detail is correct, if silver's real scarcity is about location and deliverability, not total ounces, then the move doesn't need everyone. It needs one more serious buyer at the wrong time in the wrong place with a deadline. And that's where the real pressure starts.